Identification of opening range gaps. The opening range gap is defined by the price action between 9:30 a.m. to 10 a.m. New York local time. It's crucial to observe how the market behaves within this period, especially the first 30 minutes after the market opens. Gaps can be identified by comparing the market opening price to the previous close or other significant price levels from the prior day. The market behavior within this gap, such as filling the gap or continuing in the direction of the gap, can provide insights into the day's likely price action. Utilization in strategy. Traders should monitor the market's response when it trades into or out of the opening range gap. If the price returns to and respects the gap after breaking out, it may indicate a continuation of the trend. The first move into the gap can be used as a potential entry point, with the expectation that the gap will fill, or the price will reverse if the market fails to break out significantly. Significance of fair value gaps. Fair value gaps, FVGs, represent areas where price action did not fully balance buying and selling activity, leaving behind inefficiencies in the market. These gaps are significant because they often act as magnets for price, where the market will eventually return to fill the gap to restore efficiency. FVGs are particularly important when they coincide with other technical levels, such as support or resistance, making them key areas to watch. Trading around fair value gaps. Traders can use FVGs as entry points, expecting the price to return to these gaps. For instance, if the price is moving away from an FVG, a return to the gap could offer a buying or selling opportunity depending on the market context. Monitoring price action at these gaps, especially after a significant move, can provide clues about whether the gap will be filled or if the market will continue in its current direction. Before a holiday weekend, it's essential to recognize that trading volume and liquidity might decrease as traders close positions before the holiday. This can result in less predictable market behavior, with increased volatility or choppiness. Traders should aim to secure profits early in the week, as the market's movements might become erratic closer to the weekend. It's often advisable to avoid initiating new trades late in the week unless there's a compelling setup, as the market might not move much until after the holiday. After a holiday weekend, the market typically needs time to iron out any kinks that might have formed due to the low volume and liquidity during the holiday. The first day after a holiday can be particularly volatile as the market rebalances. Traders should be cautious and allow the market to establish a clear direction before committing to new positions. Role of new week opening gaps. New week opening gaps are significant because they represent the market's reaction to developments that occurred over the weekend. These gaps can set the tone for the rest of the week, particularly if they align with broader market trends. Gaps that fail to fill early in the week can indicate strong momentum in the direction of the gap. Role of new day opening gaps. New day gaps are crucial for understanding daily market sentiment. A gap up or down can signify strong buying or selling interest right from the open. How the market handles these gaps, whether it fills them quickly or not, can provide insights into the likely direction for the rest of the day. Understanding institutional order flow. Institutional order flow refers to the large orders placed by big traders, such as hedge funds and banks, which can significantly impact market prices. Recognizing where these orders might be placed, often around key levels like fair value gaps, previous highs/lows, or support/resistance zones, can help predict future price movements. Leveraging institutional order flow. Traders can improve accuracy by aligning their trades with anticipated institutional activity. For instance, if you expect an institution to defend a certain level, you might look for buying opportunities near that level. Understanding when and where these orders are likely to be placed helps traders avoid trading against the flow and instead capitalize on these movements. Lack of liquidity and increased volatility. Fridays, particularly before a holiday weekend, tend to have reduced liquidity as many traders close out positions and avoid holding trades over the weekend. This can lead to erratic price movements. The market may not follow through on setups as expected due to the lack of participation from larger players, making it difficult to predict the direction and extent of price moves. Strategy adjustment. It's often better to reduce position sizes or avoid trading on these Fridays, unless there is a clear and compelling setup. Traders should also be mindful of the increased risk of holding positions over the weekend, as unexpected news can lead to significant gaps on Monday. Factors to consider. Observe how the market reacts when approaching a support or resistance level. If the price hesitates or reverses near the level, it may indicate respect for that level. The confluence of multiple technical indicators, e.g., fair value gaps, order blocks, previous highs/lows, around the support/resistance level increases the likelihood that the level will hold. Market context. Broader market context, such as the overall trend in recent price action, should be considered. In a strong uptrend, resistance levels might be more likely to break, while support levels hold in a downtrend. Volume analysis can also provide insights. Higher volume at the level suggests a stronger reaction, while lower volume might indicate a possible breakthrough. Challenges. Impatience. Traders often struggle with waiting for the right setup and may enter trades prematurely. Overconfidence. Success in a few trades can lead to overconfidence, resulting in overtrading or taking on excessive risk. Fear and greed. Fear of losing out, FOMO, or the greed for more profits can lead to poor decision-making. Overcoming challenges. Discipline. Developing a disciplined approach, such as sticking to a trading plan and predefined setups, can help mitigate impulsive decisions. Self-awareness. Recognizing emotional triggers and taking steps to manage them, such as taking breaks or reducing position sizes, can help maintain objectivity. Continuous learning. Regularly reviewing trades and seeking to improve through backtesting and education helps traders stay grounded and avoid common psychological pitfalls. Benefits of backtesting. Backtesting allows traders to see how specific setups and strategies would have performed in the past, providing confidence and refining understanding. It helps in identifying patterns and behaviors in price action that may not be immediately obvious in live trading. Application to trading. By backtesting, traders can develop a database of setups that have historically worked, giving them a clearer framework for recognizing high-probability trades in live markets. It also allows traders to optimize their strategies by identifying the conditions under which certain setups work best, leading to more informed decision-making. Identifying high-probability setups. Focus on setups that align with higher time frame trends or key levels that are likely to attract institutional interest, even in low liquidity environments. Look for confluence between multiple technical factors, such as fair value gaps, order blocks, and support/resistance levels, which can still provide reliable signals in low liquidity. Adaptation to low liquidity conditions. Be more selective with trade entries, understanding that not all setups are equally reliable in low liquidity. Smaller position sizes and wider stops may be necessary to account for increased volatility. Avoid trading during periods where the market is particularly choppy or directionless, as these conditions often lead to false signals and quick reversals.